Are you curious about options trading but unsure where to start? Maybe you've heard the term calls and puts but don't know what they mean. Well, you're in the right place. Today, we'll break down options trading step by step so you can get started confidently and maybe even start profiting. 1. What are options? Let's delve deeper. Options are like flexible tools in the financial world that let you bet on the future price of an asset. Here's an analogy. Think of options as booking a hotel room. You pay a fee, the premium, to reserve the room at today's price, even though you might use it later. If the price of the room goes up and you still have your reservation, you benefit by paying less than the current market price. Options come in two primary forms. Calls. You can buy an asset if you think the price will go up. Puts. You can sell an asset if you think the price will go down. Options are traded on a variety of underlying assets, not just stocks. They can be tied to indexes, commodities, currencies, and more. 2. Why trade options? Here's a closer look at why options are attractive. Leverage. Options let you control more shares with less money compared to buying the stock outright. Hedging. If you own a stock and worry about a potential drop in its price, buying a put option can limit your loss, like insurance for your investment. Income generation. Advanced strategies like selling covered calls allow investors to earn premiums from others who buy the options. 3. Key terminology. Getting familiar with these terms is crucial because they form the backbone of options trading. Intrinsic value versus time value. The premium of an option consists of these two components. Intrinsic value is the real, tangible value of the option if exercised. Time value reflects the potential for the option to gain more value before it expires. In the money item, at the money ATM. Out of the money OTM, these terms describe an option's relationship to the strike price. For example, O call option IDM. Stock price is above the strike price. O put option IDM. Stock price is below the strike price. 4. Basic option strategies. While starting with simple strategies is wise, here's how they work. 1. Buying calls. O scenario. You predict the stock price will rise above the strike price before expiration. O example. You buy a call with a strike price of $50 when the stock is trading at $48. If the stock hits $55, your option gains value. 2. Buying puts. O scenario. You expect the stock price to fall below the strike price. O example. You buy a put with a strike price of $30 when the stock is trading at $32. If the stock drops to $25, your option's value increases. 5. Understanding the risks. Here's an expanded view of risks. Expiration. Unlike stocks, options have a fixed timeline. If your prediction doesn't materialize before the expiration date, the option becomes worthless. Volatility decay. Options can lose value due to time decay, theta. The closer you get to the expiration date, the faster the option's time value erodes. Market misjudgment. You might predict the direction of the stock, but not see enough movement to profit. Tools and resources for beginners. Educational platforms. Websites like Investopedia, Option Alpha, and Tasty Trade offer comprehensive lessons for free. Simulators. Paper trading platforms such as Thinkorswim simulated accounts let you practice without risking real money. Community forums. Reddits/options or dedicated Discord groups can provide insights and answer your questions, but be cautious of advice from non-professionals. Next steps. Here's your action plan. 1. Learn more. Continue reading about option strategies, risk management, and market analysis. 2. Start practicing. Use a paper trading account to execute your first trades. 3. Stay disciplined. Stick to your strategies and avoid emotional decision-making. 4. Expand slowly. As you gain confidence, explore advanced strategies like spreads, straddles, and iron condors. Options trading can seem overwhelming, but with the right foundation, you'll be off to a strong start. Remember, start small, learn as you go, and focus on managing risk. If you found this guide helpful, don't forget to like, subscribe, and drop a comment below with your questions.